Joining us right now to kick off the trading week is Alicia Levine. She's head of equities and capital market advisory at BNY Mellon Wealth Management. Also, of course, our guest host this morning is Stephanie Link, who's the chief investment strategist at Hightower and a CNBC contributor. And Alicia, I'm not sure if you heard our conversation in the last block where Steve Leisman was telling us about the Fed timing. That's pretty important news, breaking news this morning. And I just wonder if that changes your perspective on any of this. I feel like we've all been kind of waiting for Godot to see when the Fed would actually start to pull back some of those asset purchases.
Hi, good morning, everybody. I did hear it. It doesn't actually change what we've been thinking, because we have thought that a series of stronger jobs reports as we get closer to that expiration of the extra unemployment insurance would lead to the Fed tapering probably by December this year. And in the end, what hurts markets is the information you were not expecting. And as you point out, this is waiting for Godot. So markets are waiting for some sort of signal on this, whether it's a month early or a month later than expected. I don't expect that to really change market pricing here. I think there'll be some slowdown just on the strangeness of how Delta acts and some caution there. But ultimately, we do see the taper starting by December of this year.
You know, the market's taper tantrum back in 2013, that, I guess, was very different circumstances than we're seeing right now. Unemployment's only 5.4% right now. Inflation is much hotter. But the biggest reason for the longest time that people have said you've got to invest in the stock market is because there's no other alternative when the Fed is doing things like this. It's the only place that you can put your money where you can get any sort of return. What would tip that? I mean, tapering is pulling back some of the stimulus that's out there. Do you wait until the Fed raises rates, or does that even change the picture?
So I don't think it really changes the picture, because ultimately yields are really what's driving all of this. There is no alternative story. And in the end, our bond market is tethered to the $16 trillion of negative yielding debt. And as we know, there are forced buyers of that debt and forced buyers of our debt. So you sort of have a natural lid on how high yields can go here. And as a result, your best bet is still in the equity market. And so even with a taper, and even if we decouple rate hikes from the taper, we still have a very, very, very long way to go here in really drying up liquidity in our markets. We're sloshing around for a long time, and incremental taking it back will not change the fundamental story, which is that demand is enormous, yields are low everywhere, and this is where you get return, equity markets.
Alicia, can I ask you, just switching over to earnings? Earnings were really very good, actually, in this past second quarter. I know 80% is not sustainable, and we are going to see a slowdown, but 85% of the companies beat in the S&P 500. So very encouraging, very broad-based. Guidance was very good. One of the things that I think was really notable was the free cash flow generation was extraordinary. What do you think companies are going to do with that free cash flow? Are we finally going to get a CapEx cycle, or are these companies just going to increase dividends and increase buybacks like we've seen for the last 10 years?
So that's a great question. We actually had this discussion last Friday, as a matter of fact. What are companies going to do with the cash? We think it's clear that there's a CapEx cycle coming here. The inventory discussion from your earlier show really drives home the point that shelves are bare and inventories have to be restocked. So with the cash, we see a CapEx cycle, not just in tech, but in goods as well. And the bipartisan infrastructure bill, while it's not so important for the macro story, will be important for certain industrial and material sectors. So you're going to see a boom there. You know, it's what's really interesting here is that outlier events make it very hard for Wall Street to model. So not only did we have a hard time modeling what was going to happen with the economy, but it turns out that it's hard to model the earnings recovery when revenues are growing so high and you've made real streamlining of large corporations part of surviving the pandemic. And what we saw was an immediate drop to earnings. That's going to be moving forward. So I think you get CapEx, I think you get investment, and I think you get inventory build.
Alicia, thank you for joining us this morning. It's good to see you.
Nice to see you guys.
Take care.
Shepard Smith here. Thanks for watching CNBC on YouTube.